Welcome to WOW, the Wealth Optimization Workshops. Welcome back. Scott Collier, the Call Dog here. Excited to dive into some of the investment strategies and investment fundamentals that we think people should understand when they're looking at their investment portfolios. Certainly equips you well too when you're interacting with your financial advisor and having some conversations. I know you're not going to be able to see all the details here. That's okay. You don't need to read all these numbers and zigzags and all that to understand the basic concept, because this is what's called an index chart, actually made out of Windsor, Ontario, the index chart. This one, thanks to CI Investments for providing this one. This is often seen on practically every financial advisor's office, whether you're in a certified financial planner, a stockbroker, a bank advisor, whatever the case might be, but often you see these, but it looks impressive, lots of zigzags and here and there, but here is the key fundamentals that are beneficial for you when you're trying to understand the markets and investing and not overcomplicate it with all kinds of complex numbers and mathematics. So here we go. What this looks at, so back here on all of them, $100 is what you started with. So you invested $100 one time, added nothing to it. And then you let it grow from 1950 to now. Now, is that realistic? Not typically that you're going to let money invest that long. However, even 10 years, and certainly 20, 30 years, are long-term investment time horizons. So on short-term investments, aggressive growth does not make sense. Safety of your principal is what makes sense on short-term savings, emergency funds, things of that nature. However, if you are investing for long-term planning, for example, your retirement planning, or you had young kids and their education savings, or other types of long-term investment strategies, what we look at is growth becomes excessively important. So I'm just going to give you a couple examples here. That $100, nice smooth line called a GIC, and that's with over those 68 years. The average rate of return on a GIC, 6.4. If you've invested in GICs lately, you know that it's more like 2.5 range, 2.35 even. 3% would be exceptionally good. So that's not even typical, but it's nice and smooth. However, on a long-term investment, $100 grew to $6,026. Sounds pretty good, right? Put in $100, get $6,026. However, this blue line, so the most aggressive or volatile of the indexes being assessed here, we look here, $535,000 over the same time span. So if you can notice, much more volatile on up and down, but it's averaged 13.8 over that time. 535,000 instead of 6,026. What's my point? On short-term investing, do not be taking risks in the market with the potentials of volatility. However, in the long run, the biggest risk to you is not whether the market's fluctuated from one month to the next. The biggest risk to you is that you should have had maybe even, let's go with, say, $300,000 on your investment, but you ended up with that because in the long run, you averaged far less growth than you should have. Hopefully that makes sense to you. So what do we know in the investment markets? Diversification is important. What's your investment objective? What's your time horizon? What is your personal risk tolerance? Those are all factors in how you should choose your investments and diversify them using proper asset allocation that we'll talk more about. Right? But this is a few key points too when you see these index charts and they seem real busy. Down here you see different presidents of the United States, different prime ministers, different political parties in power over time. What's the point of all that? Same as these little black dots, different crises, the oil embargo, the Vietnam War, the Persian Gulf War, all kinds of different things, 9/11, that have transpired historically throughout time that put all these dots. What's the point of any of it? It doesn't really matter who is in power, regardless of what politicians tell you. and it doesn't matter whether there's different crises that happen along the way. The markets always go up much more in the long term than they go down. So they have significant long-term growth. However, they do have temporary market declines, regardless of who the politicians are, regardless of what little things come up along the way. You see these light whitish gray areas? The dark gray, that's market declines. The big periods of light color, that's the periods of growth. So what we know is that markets grow in the long term. They do have temporary setbacks, and we won't be shocked if there's a temporary market decline coming. We know that the end of 2018 was a little rough. But you can have confidence, if you are investing for long-term purposes, that the markets grow in the long run, that growth matters significantly in how much your money will grow over a period of time, and that regardless of what politicians tell you, or what temporary blips in the economy, recessions, different crises that happen along the way, those will cause temporary declines. The biggest declines are always followed by the biggest up markets. But the markets have always grown and will always grow in the long term. Hope that makes sense, gives you some good insight as we dive into some investment topics moving along. Hope you have an awesome day.